Hey guys, it's Sam here from MarketMates. I've been trading and working for major global brokerages for the past 16 years. I recently turned 43, so I've recorded 43 lessons that I wished I knew when I first started trading. Start with your objectives first. So about 10 years ago, I was talking to a hedge fund manager friend of mine, and I asked him about his top tip for trading, and he said start with your objectives first. I think this is a great place to start these lessons too, because many traders focus more on market analysis and less on setting good objectives in the first place. So what you want to do is set objectives and then build a trading strategy in order to achieve those objectives. Risk reward is everything. So your job as a trader is to find trades that have asymmetrical risk reward profiles. So it's a fancy word, but what that means is you're looking for trades where the upside is far greater than the downside, or the potential for gain on that trade is much higher than the potential for loss on that trade. You are a risk manager first and a trader second. So this lesson is all about playing good defense. So your top priority as a trader is firstly to protect your trading capital, and after that it's to figure out how to make money. Cut your losses short and let your profits run. So this is an oldie but a goodie. And to illustrate how old this concept is, I'm going to read to you a passage from this book. This book is called Speculation as a Fine Art and Thoughts on Life, and it's by Dixon G. Watts, who was a trader in the 1870s and 1880s. And he wrote down a number of rules and laws about trading. So here's one. The rule is to stop losses and let profits run. Not to have the courage to accept a loss and to be too eager to take a profit is fatal. It is the ruin of many. And I've seen this very much in my time working for brokerages. Because one thing that I notice about retail traders in particular is many traders are quite good at picking the market direction. You can see that in the statistics. But what they don't do well is when they are in profit, they are very quick to take that profit. They're not willing to let their profits run. And when they have a losing trade, they're very slow to take that loss and they end up with big losses. So what you'll see in a typical retail trader's portfolio is small win, small win, small win, and then a large loss. And that large loss costs more than what you'd be making from the wins. So the key here for successful trading is to have the courage and discipline to cut your losses short and let your profits run. Be properly capitalized. So the main reason that I've seen traders lose is because they have small accounts and then they're using a lot of leverage. So they end up taking large positions for the size of their account. And you can imagine if they're not particularly good at cutting their losses short, that this is a recipe for disaster. And I think this is the main reason that traders are unsuccessful. So it's very important in trading that you are making sure you take a small amount of risk compared to the size of your trading account. Use a rules-based approach to trading. The person that I learned the most about trading from was Dr. Van K. Tharp. Dr. Van K. Tharp, he's sadly passed on now, but he was a famous trading psychologist, coach, and he was featured in the original Market Wizards book. And one of the things that he said that always stuck with me was 90% of the successful traders he's seen were discretionary rules-based traders. That is, they had a set of rules for every single decision they need to make when they trade. Interestingly, the other 10% were not no-rules traders or intuitive traders. Rather, they were mechanical rules-based traders. So they had a set of rules that they then coded and used an algorithm to execute the trades on their behalf. So what you want to do as a trader is develop your own set of rules, test these rules, and then make sure you follow them when you trade. Be clear and specific. I'm a Kiwi, which means I come from New Zealand. And in New Zealand, we love our rugby. And our national rugby team is the All Blacks. One of our most successful All Black coaches, Steve Hansen, he always used to talk about this idea of clarity. And he would say the player needs to be very clear about their role and then they need to go out and execute their role to the best of their ability. And I think this is a great frame for traders as well. So we need to be very clear about our goals, what our objectives are for each individual trade we place, our entry, exit, and risk management rules. And if we're not clear, then it means we need to do more planning until we do become clear. Mistakes kill trading systems. So I track every single trade that I place. And what I've noticed is typically when I have a losing month or a losing period, it's not down to the rules of my trading strategy. Rather, it's down to my failure to correctly implement those rules, i.e., I've made a mistake. And to be very clear, a mistake is not having a losing trade. We're going to have lots and lots of losing trades in our career. That's part and parcel of good risk management. And you can see losing trades as just the cost of doing business. But what we want to avoid is making mistakes. So it's very important that you track your mistakes and then take steps to eliminate as many mistakes as you can from your trading. And this could mean the difference between you being a successful trader or not. It's that important. Trade your best idea. One of the key challenges we have as traders is there's lots of opportunities out there. There's thousands of markets. They're very easy to access. You can trade them almost any time of day and in whatever way you want. So there's plenty of opportunities. In particular, with a little bit of experience, you'll go and see lots of opportunities just by looking at charts. You'll see trends you want to capture or moves you like or large moves around news events. But the challenge we have as traders is if we try and chase all these opportunities, we're going to lack focus. So what I suggest is you focus on one idea at a time. Ideally, that's your best idea, but it doesn't even have to be your best idea. Just stay focused on one idea and do the hard work that is required to get good at trading that particular idea. This doesn't mean you can't trade other ideas. I have a list where I write down all the different ideas and opportunities I see, but I tend to stay very focused on one or two ideas at a time. And this is very, very important to me and to my trading success over the long term. Trade the correct strategy for the market type. This idea comes from Dr. Tharp. And what he would do is he would break market conditions down into around 40 different market types. And the concept being you identify the market type first, and then you trade the correct strategy for the market type. And I really love this idea, and I think it's essential to trading because otherwise traders will tend to spend their time searching for a holy grail trading strategy. That's a trading strategy that works in all market types. Whereas it's much easier to trade a strategy that just works in a small number of market types. And to break this concept down even further, you don't need to necessarily know all 40 market types. Essentially, you can look to buy in bull markets, sell in bear markets, stay out of or range trade in sideways markets. If the market forms a tight range, then you can trade the breakout. And if you identify overbought or oversold market conditions, you can look to be a contrarian and trade in the opposite direction. So the key here is to identify the market conditions and then trade the correct strategy for the current market conditions. You will not win all the time, and that's okay. Even the best traders have losing weeks, months, or years. So if things are not working for you, go easy on yourself and keep pushing, keep learning, and keep trying to improve. Trade less and not more. In my time working for brokerages, I've seen the difference between successful traders and less successful traders. And the successful ones tend to trade less and focus on less markets, whereas the less successful traders tend to have lots and lots of positions on lots and lots of different markets. And this makes it very challenging for them to manage their portfolio, and they'll often end up with lots of correlated positions that will all move against them at the same time, which means it's difficult to effectively manage your risk. So when I trade just USD yen. And over the past 3 years, I've managed a 3% a month return. And I'm trading USD yen only one time a day, actually typically less than once a day. And this is all I actually need in order to achieve my objectives. So I'd highly encourage you to remain very focused on one or two markets and not to trade too often. You only need one good trade. So further to the previous point, You don't need lots of trades in order to achieve your objectives. In fact, what I find, if I have 1 or 2 good trades a month, typically that's enough for me to achieve my objectives. And you'll notice that successful traders, they will generate a large amount of their profits from a small number of their trades. They're just very good at capitalizing on those good trades when they do happen. You achieve your goals through position sizing. So when I've studied top traders, what I noticed is that a lot of traders would talk about the importance of controlling the size of their position. And in fact, they would emphasize this as being more important than actually getting the direction right. I think this is quite a valid idea. Because if you think about it, you could have one great trade, have a small position size on it, and then have one losing trade with a large position size on it. And despite having a great trade and a normal losing trade, you end up in the negative. And that all comes down to position sizing. So what's very important for you to do is focus on creating a position sizing model that's going to help you to achieve your objectives. It's not how often you win, but how much you make when you do. It's okay for your trading account to have lots and lots of small losses. And in fact, this might be desirable because this means you're cutting your losses short. But what matters is that when you do have a winning trade, you make sure you capitalize on it. And when you have a winning trade, you end up with a large gain that pays for the losses that you have been taking in the meantime. Play the probabilities and not what you think is going to happen. So a good trading strategy has what we call an edge over the markets. So if you place enough trades over time, you're going to be profitable. Any one individual trade might be a loser, but because your strategy has an edge, it makes money over the long term. The challenge, and I've had this challenge, is when I go to place a trade, or when I'm in a trade, I'm looking at something going on in the market and I'm thinking I know better than my trading plan. So rather than follow my plan, I might close a trade early, or I might try and trade in the opposite direction because I think the market's going to go down rather than up. Or I might decide this doesn't look right, I'm not going to place a trade. But what I've noticed by recording my performance and doing this is that it actually is a significant drag on performance. And what I need to do is trust in the probabilities, trust in my plan, and just execute the trade and not try to think that I know better than what I've planned is going to happen. Time of day matters. So in Forex markets, you'll notice that at certain times of day, volatility and volume increases or decreases. And this is for very logical reasons. It's because traders have working hours, they come to work. Other market participants, such as companies that buy and sell currencies, they come to work at certain times of day. And as the clock shifts around the globe, different traders go to work and come home. And this all leads to changes in volume and volatility in their particular working hours. So as traders, we need to pay particular attention to the Sydney market open, the Tokyo market open, Europe and London market opens, and the New York open, and the closes of these markets as well. So we need to be very prepared around the particular times of day that traders are actually there at their desk trading. Don't trade on Monday mornings, and I'd add to that, don't trade on Friday afternoons in New York as well. So the market conditions can get quite illiquid at these times as traders are establishing their positions for the week. There's not many market participants. Perhaps on the end of the week, they're closing their positions. So you can see erratic moves. So I suggest you stay away from trading on Monday mornings and Friday afternoons. And when I learnt this and stopped trading on Monday mornings, it had a significantly positive impact on my trading performance. So I'd encourage you to think about this too. This could also mean even staying away from the markets on Monday and starting your trading day on Tuesdays, but it's something for you to go away and test. Keep your entries simple. So I'm going to separate entries from market analysis here. So what you want to do is have a separate step where you conduct your market analysis, where you identify the conditions you want to see before you enter the trade. But then once you've entered those conditions, we want to have a very simple entry rule. And the reason for that is At this point, we need to be very decisive when we're trading because timing matters. We may have large positions that we need to execute quickly, and we don't want to have a complicated or convoluted set of rules that cause us to make mistakes. Keep your exits complex. Unlike your entries, it's okay to have a more complex exit strategy. And the reason for this is when you enter your trade, you're in control of the conditions at the point of entry, i.e., if you don't like the market conditions, you don't need to enter. But once you're in a position, all sorts of things can happen. So you need to be prepared for the different changes in market conditions once you enter the trade. So it pays to have a toolbox of different exit strategies. Additionally, when you're trading, it can be a good idea to exit in parts. So you take a little bit of profit when the market makes some available. You take a little bit more at your main objective, and you leave some on just in case there's a big winning trade. And if you are going to have this suite of rules here to cater for these different market conditions and exiting in parts, and it's going to result in having a more complex exit strategy, and that's okay. Take some profits when the markets get overbought and oversold. I used to hope when I first started trading that every single trade would be a big winning trade. And what used to happen is I'd end up in these very nice winning trades, and then the market would quickly change direction and go down and hit my trailing stop, or worse, turn a winning trade into a losing trade. So what I learned to do was be more prudent in my trading approach. And if I noticed that market conditions were overbought or oversold, I started to take some profit. Now, this didn't mean I would take all of the position off, although sometimes it would mean that, but I would at least make sure I exited part of my trade when I noticed market conditions were about to change and I could see the market starting to reverse. Trail your stop loss, but not too close. A trailing stop is an important part of protecting your gains when you trade, but the challenge can be if you put it too close, it's going to knock you out of the trade. So understand your objective for the trade and make sure you apply a trailing stop that doesn't get too close, so it's going to whipsaw you out of the trade and not allow you to achieve your objective based on just normal market movements. Move your stop to break even, but not too early. So like a trailing stop, moving a stop to break even can be a great way to lock in your gains. And indeed, it's very nice if you have moved your stop to break even, because at that point you have what is essentially a risk-free trade. So unless there's some sort of market event that causes some slippage, you're either going to have a break-even trade or a profitable trade. The challenge here, but like a trailing stop, is we don't want to move it too close that it knocks us out of trades that would eventually go on and achieve our objective. So what I would typically do is once a trade has made 2 or 3 times my risk, I'd move the stop to break even. Or if there is a very rapid market movement due to some news, which I know can very quickly reverse, I'd move my stop to break even. But otherwise, I don't want to put it to break even too early. News events will be your greatest source of profits and losses. As I sit here doing this video, last night there was a 420-ish pip move on USD yen. This happened in around 45 minutes on the back of US inflation data. So if you're not prepared for these types of moves in the Forex markets, often you're going to find yourself in a winning position and then it very quickly evaporates. Of course, there's also the opportunity to profit from news trades. And just to add a caveat here, it's not as easy as what it seems, because often news events can mean that the price becomes very illiquid and it can gap through your stops. So while you have the potential for a large gain, you can have the potential for an outsized loss as well. So it's very important for traders to make sure you know when news events are coming and plan what you're going to do around that event, whether it's for your existing position or whether it's entering into a new position. Record your trades. Tracking and measuring your trading performance is perhaps my top tip for traders. I think that while this is perhaps the hardest work to do, to make sure you have good structures for recording all your trades, if you do that, it's the easiest way to improve your performance and eventually achieve the success you want from your trading strategy. Do more of what works and less of what doesn't. This is my favorite trading quote. It comes from Steve Clark, who is featured in the Hedge Fund Market Wizards book and is the founder of Omni Partners. And this is why we do the previous step. It's why we record our trades. We record our trades so we can analyze them and do more of what's working and less of what's not working. And if we continually repeat this process, then we can't help but get our trading strategy to a point where it's achieving what we want it to achieve. Know your macros. And I'm not talking about calorie counting here. I'm talking about macro analysis of the Forex markets. By understanding macro analysis, you'll learn what is actually causing the movements behind the charts. And this is very important because it gives you more conviction and confidence in your trading. So what I did when I wanted to learn macro analysis is I spent around 3 months reading every single thing I could. And then every week, I would write down my macro view about the markets. And then of course, I would also place trades based on this macro view. And that would help me understand if my ideas or my thinking was valid or not. So I'd highly encourage you to spend some time really learning macro analysis and what moves the Forex markets. And to give you a little tip here, the key thing to understand in Forex is interest rates, because interest rates cause the long-term price movement. So you need to understand interest rates, and you need to understand, because of that, what central banks are doing and thinking. Scale into high conviction trades. So if you do have a trade that you really like, perhaps because you like the fundamentals or the macro reasons for the trade, and you have a lot of conviction in the position, then it's important to maximize it. And you can do this by adding to the trade as it goes your way. If you take a very large position at the beginning, that's also an option, but of course that increases your risk. Whereas if you add to the trade as it goes your way, you have more control over the risk, but you can still build a large position. And this has led to the best trades of my career. So I think it's a very important idea and skill to have, to be able to add to your winning trades that you really truly believe in. Practice mental rehearsal. So it's important when you're trading that you get into the correct state of mind. You don't want to be too excited. You don't want to be too low. So normally the correct state might be this calm state where you're around 5 out of 7 and you have a positive expectation about what's going to happen. And you also want to make sure that you're performing your execution of your trades as best as you can. So a bit like an athlete who prepares the night before an event by practicing the kick over and over and over again, or practicing the shot over and over and over again in their mind's eye. You want to do that as a trader. And I've found this to be the most effective way or time efficient way of getting in the correct mental state. So there is certainly other ways, such as meditation, which of course is great, but here you can practice and rehearse your trading. Normally takes me around 2 to 3 minutes. I do it before I go to bed. I'll just lie down, practice executing my trades perfectly, and at the same time I'll breathe deep. And then before I go to execute the trade, I will trigger that same mental state by doing some more deep breathing, and it gets me into that state of mind where I'm in the zone and focused on perfectly executing my trade. So I'm a big believer in mental rehearsal. Trading is a game. So when I studied top traders, one of the things that I come across all the time in the literature was this concept or this idea that trading is a game. And it happened remarkably often amongst top traders. And I love this as a frame of mind for trading because it takes the pressure off. We don't necessarily want to be focusing on money when we trade. We want to be focusing on the process. And I also like this idea because it helps us understand that we can create our own rules. So trading is an unlimited environment. You can trade almost anything, any time of day or night that you want, as long as you have money. But what you can do is you can create your own set of rules that serve you in the markets. So it's a game where you develop the rules. And I also like thinking of it as a game where your profits are the score. So having this mindset that trading is a game is something that I would encourage you to think about and cultivate for yourself. Develop personal discipline. So the key to consistent trading is to continue to trade your plan even after a series of losses. So you need to develop the personal discipline to continue to trade even if you had 3 or 5 or even 10 losses in a row. It's a critical aspect of successful trading performance, because there's always going to be these periods where your trading strategy doesn't necessarily work. But what you don't want to do is fail to execute it properly, and then you miss out on the winning trade that would have paid you back for all those losses. Keep your thinking flexible. While it's important to have confidence and conviction in your trade ideas, if you see some evidence that suggests otherwise, you want to have the mental flexibility to be able to get out of your position, or perhaps even do a U-turn and trade in the other direction. Trade for yourself and not what others will think of you. So I learned this lesson for myself when I ran a Forex signals business. So we started off with very good returns. It was about a 40% return in around the first year and a bit, and we had very limited drawdowns. But what happened was, rather than continuing to simply execute the strategy that had got us the returns in the first place, I started to focus on making sure I protected the returns we'd already achieved. And the reason for that was, as a signals business, your returns are one of the main things that gets you new customers. So rather than executing the plan, I started to trade for what other people would think about me or my trading results. And obviously this was the wrong decision, because it led to a deterioration in the performance of the trading strategy. And this is particularly true, I think, nowadays, where there's social media and you're seeing traders doing all sorts of things. We don't want to base our trading or our trading results on what we're seeing other people do. And rather, we just want to stick to our own guns, and you need to just do you for you when you trade. Know yourself before you trust others. So before you ever consider giving money to someone else to trade, it's very important that you understand what trading is about yourself. And in particular, you understand risk management. This way, if you're going to give your money to someone else, you'll know what the right questions to ask are, and you'll be able to determine if you think they're a good trader or not. Your broker is probably not your enemy. I've worked for brokerages for a very long time, and one thing I can say is that brokers are trying to do the right thing by their clients. Typically, they're going to give you good trading conditions to execute your trades, and they're not going to play any funny games or anything. So this is true of the major regulated brokers that I've seen. There's certainly a subset of brokers that you need to be very wary about. But if you stick to the regulated brokers, then you're typically going to be okay. But the broker is not your mate. So it's very important to understand that while they're going to give you good trading conditions, they're not particularly focused on your trading success. And this is, I guess, normal. They're focused on the objectives of their owners and shareholders. But what this means is, if you're a losing trader, for example, they're not going to give you a call and say, "Hey mate, slow down, trade less. How can I help you?" And in fact, what they're more likely to do is recognize that you're a losing trader, take the opposite side of your trades. Doesn't mean that they're going to actively disadvantage you, but they're just happy uh, playing the probabilities that you're going to lose. And then when you do lose those funds, they're going to call you up and say, "Hey, can you put more in?" Because they've figured out you're a losing trader and that you've become a source of profits for them. So it's I guess that's just the nature of it, and maybe it's a little bit sad in some ways that that is the case. But it's important to understand that the broker is not focused necessarily on your trading success, and that's not their top priority. Costs add up. So costs compound negatively, just like gains compound positively. So it's very important that you do what you can to eliminate this drag on your performance and reduce transaction costs and fees as much as you can. There is always a market maker. When I first started working for brokerages, almost everyone would ask me, "Are you a market maker?" And this was because at the time there was a perception that market makers are bad because they are actively disadvantaging you so they can profit from your losses. And of course, this can be the case sometimes. And my view is that yes, some market makers are good and some are bad, and it really just depends on the brokerage and the way they choose to operate. Now, what I want to make the point here though is that in the Forex markets, there is always a market maker. Because there's no centralized exchange, if the broker is not the market maker, then their liquidity provider will be. And if the liquidity provider is offsetting some trades, they're going to be sending that to a bank. And that bank is going to be the market maker. So there's always a market maker somewhere down the line in the Forex markets. Grind it out. So there may be this perception because of the availability of leverage and the rapid movements you see in Forex markets that are generated by news, that Forex markets is a way to generate fast gains or quick profits. And yes, there is certainly the opportunity to do that, but that typically comes with equal, if not greater risk. So I think the better frame of mind to think about trading is you want to grind it out. So you want to show up each day, follow your process, and then the results will come from that. So grind it out, work hard, keep growing, keep learning, keep improving, and that's the way you actually will ultimately get what you want from the markets. Don't tie your self-worth to the markets. Trading is challenging. It can be quite hard at times. And you don't want to base your emotional well-being on your trading performance. And in fact, if you do this, it can have the opposite effect of what you want because you end up trying too hard. And the markets are not something that you can try too hard to do. You need to be patient, disciplined, and prudent rather than trying to force your way through them. So what you need to do instead is just relax, follow the processes, and just keep working hard to get better. Spend your time being happy. This idea comes from Paul Tudor Jones, who's in the original Market Wizards book, and he says that he likes to spend his days being as relaxed and happy as he can. I think this is a great idea for traders because it puts us in the correct mental state. Ideally, we want to be relaxed, happy, calm, and have a positive expectation for the future. Fight the good fight. Author Paulo Coelho, who's a great author, by the way, writes an excellent book called The Alchemist. It takes about 40 minutes to read if you're interested. He says the good fight is the one you fight in the name of your dreams. So if you're passionate about trading, then I encourage you just keep fighting, keep learning, keep growing, and eventually you'll get to where you want to be. Enjoy the journey. So there's no doubt that trading is challenging and there's a lot of emotional highs and lows. It's a bit like a journey through the mountain range or the Himalayas. We have these very high highs where you think you've mastered things, or these lows where you're taking losses. It often feels in trading because you have a profit and then you have some losses, you have a profit and some losses, that you're taking 2 steps forward and 1 step back. And because of this, I think what's most important is we recognize that trading is a journey. It's something that, well, at least I hope to do for maybe the next 50 years or so, if not longer. And my goal is just to enjoy the journey along the way. Be curious, keep learning, keep growing, and keep developing myself as a trader and myself as a person. And I encourage you to think the same way about trading for yourself. That's all 43 lessons. So if you like these lessons, then as I've been doing this video, I realize there's a whole lot more that I'd quite like to share. So if you like them, please subscribe and comment. I also have this course called the Advanced Forex Course for Smart Traders 2.0. It's 100% free. It will always be free. It's got 17 in-depth lessons there. So you can go and sign up for that as well. It's in the link below. And thanks again for listening, and I'll catch you next time.